Hello everyone, good afternoon. Today, on behalf of Atal Innovation Mission, I welcome you to another session for this Thursday. The speaker for today is Mr. Nishant Malhotra, founder, director, and CEO, Middle Road OPC Private Limited. Nishant is the founder of social impact startup Middle Road, a social enterprise enabling social change and impact within the society. Middle Road is a social impact enterprise and has an online platform. Multifaceted and well educated, he has a master's degree in public administration from University of Michigan, Ann Arbor, and MBAs from China Europe International Business School, Shanghai. He has a BE degree from VIT Pune University. He wore many hats during his career and worked across diverse industries with focus on financial services. As a business leader, Nishant set up the financial advisory desk in private banking at ICICI Bank. A prolific social enabler and a fitness enthusiast, Nishant is catalyzing a continuous change within the global ecosystem through his timeless work, which includes work as a volunteer in visually impaired school in Pune. Sir, we welcome you. Over to you now.
Okay, thank you, Malika. Thanks a lot. Just before I begin, just a couple of corrections. I was working at a visually impaired school. That was some long time back, and I think you just missed out that I also did my MBA from Symbiosis Institute of Business Management, India. But thank you for a very riveting introduction. So today I'll be presenting. It'll be a presentation on global fixed income markets. We'll have also, it will be focused a bit also on India. We'll take a few examples. So let's start with directly with the presentation. So thanks, you already made the introduction. So I'll just go into one aspect that I have also got an e-learning vertical. I take some interesting modules. You could check it up in macro finance, macroeconomics, it's in valuation. You also have a bit on impact investment and statistics. So now let's start with the agenda. So today, the whole point is like we are going into a brief yet a detailed overview of the global debt markets. We look at who are basically the prime actors within the market. We'll look at some of the examples. We'll also see some of the classifications of bonds, which are very important. And we look at a few policy tools or interventions which have been done specifically in the Indian sector to boost liquidity or, to boost corporate bond market. So we'll just look at some of the examples. We'll not go into a deep dive, but it's a pretty comprehensive, going to be a pretty comprehensive chat. So let's start with. So just to begin, there's some key references. So Frank Fibozzi is a very good book to refer for financial to understand bond markets. Now this presentation which I'm doing is a bit offshoot of also global debt markets which I have on my platform, but there are certain differences. So let's start first with what is a bond. Whenever we are talking about a bond, we're talking about a fixed income and debt instruments. They're usually secured. If it's unsecured, we call it debentures. Now, issuer is a debtor or a borrower. So whenever we are talking about bonds, we are talking about today plain vanilla bonds. They're also embedded bonds, but we'll not be going into higher classification of embedded bonds. We'll just be looking at today a plain vanilla bond. So whenever I'm talking about plain vanilla bond, I'm talking about a bond which has got a fixed period. There's a fixed time duration for borrowing. You have coupons or basically interest, which is paid on the face value to the lender or to the bondholder, and the principal is paid at the end of the tenure. And whenever you're talking about interest rates, it could be fixed or floating. So before we do a deep dive and before we look at the various actors, it's always good to have a bit of terminologies in space because it makes life a bit easier. So whenever we are looking at bond, looking at principal bonds, we are looking at we understand it's basically everything has got a par value or a face value. That's what we're talking about, principal amount. The coupon rate is actually paid on the principal amount. Now, 1 minute just sticks. So now term to maturity. Now, this is a very critical factor whenever you're talking about term to maturity. The term to maturity could be from short term, medium term to long term. Now, this aspect, whenever we are talking about the aspect to medium term. Now this definition varies according to the books. So I have followed Fibonacci's definition, and we have taken 5 to 12 years as medium term, and long term is anything above 12 years. Now in India, the when we talk about the markets basically from T-bills, we look at from 3 months duration to 40 years, but this could vary. We have seen bond coming up with by far much higher duration if you look at the global scenario. Now when we look at the coupon rate, we understand it's sort of the nominal rate, which is the interest rate paid by the issuer on the principal amount. And next we come to is the coupon rate. Now the coupon we are talking about is the interest income paid on the which is what we say the nominal yield when we are talking about a bond. So am I visible here? Am I correct?
Yeah, you are.
Yeah, okay. Yeah, sure. Okay. So now we always come out with few concepts. Now, one of the very important concepts, because I'm going to be talking about yield in the next slide, is basis points. So whenever we're talking about basis points, we're always talking about, whenever you're going to be reading a paper, you'll always come across this term. So what is a basis point? So basis point is 0.01%. It's a term frequently used when you're looking at changes in the yield. Even when you look at charges, for example, when you're saying how much you're going to be charging for a particular, you'll be always looking at the basis point. Now, when we look at the yield, whenever you're talking about yield, so we have understood this concept known as coupon. So whenever bonds start trading, the prices of the bonds change. So the yield is basically the annual coupon interest divided by price of the bond. Now to make it simplify, I took a very simple example. Let's take the bond. So bond of a face value of INR, which is 1,000 rupees, is released. Usually the bonds in India would be semi-annually with semi-annual coupon rate. However, I have to simplify an example, taken an annual coupon rate of 8%. So whenever you're looking at the time of the issue, when you're looking at a yield, the yield is basically 8. At that time, 80 divided by 1,000, which will be 8%. So when you're looking at the coupon rate, 8% of 1,000 is 80. So as the prices change, so will the yield. So it will be 80 divided by 1,100, which is 7.27. So just to give you an example, how we calculate yield is basically the coupon is always on the face value. So you have 8% coupon, which amounts to 80 rupees on a face value of 1,000. As the bond starts trading, the prices change. So prices could go up and down. As the prices change, now here the prices come up. So that means people are buying this bond a lot. So at that particular time, when I'm taking the prices at 110 in a simplified manner, keeping other factors constant. So we are keeping other factors constant. It's very important when I speak about that. And then you have the yield, which is coming to 7.27, just to give you a fair idea. So when we talk about yield around the world, the most liquid is always that the 10-year yield of the government security, which is the sovereign bond. So if you want to look, if you look at any, you open newspaper, you are reading a newspaper, you go to any television, you always get, okay, this is the yield, the 10-year. So it is always the 10-year yield which you're talking about. So this is basically I've taken the 10-year lead of the the Indian 10-year bonds, the India 10-year bond, the yield. So whenever the yields are going down, what it means, it's a positive thing. That means there's a lot of buying in the bond. The prices are going up. So now we understand. And today, since I'm not going to be talking about valuation, so we'll not go into depth of how the yields or the what we mean. But whenever you're talking about yields collection, you need to also have a time constant of cash flows. So today we are not going to be discussing that particular aspect, but just to give you a fair idea. So there's another special type of bond. Now this is very important. It's a zero coupon bond. So zero coupon bonds are bonds which do not pay coupons. And as we look at basically, especially the T-bills segment around the world, including India, we'll understand why this is very important. So zero coupon bonds, they don't pay an interest. So this is one T-bill note which I got just to sort of show. This is the US Treasury bill. Now it's basically issued at a discount to the face value. And so since there is no coupon, you take it as an example that a T-bill of 3 months of 100 rupees face value could be issued at 99 rupees or 98 rupees. So which means that you will ultimately get 100 rupees at the end of three months. So this is basically you're earning three. In this case, let's say it's issued at 97. So you're earning 3 rupees over a period of 3 months. You can analyze the return just to for your sake. So this is how zero coupon bonds are paid. Now zero coupon bonds are very important because the rates on the zero coupon bonds are called spot rates, and there is something known as term rates, which is basically the yield curve. These are very important aspects also to calculate the forward rates. So since this is going to be a very the first module on bonds, we're not going to go into depth, but what it makes sense is actually this is the ground rule in bond. So if you're in bonds and you're going to be doing bond valuations, it is very important to understand the concept of spot rates, which is basically rates on zero coupon bonds. Zero coupon bonds could be of different tenure, and they could have rates which will amount to spot rates. So then you are looking at classification of bonds. Now this is actually, when I'm talking about a classification, it's very important to understand how bonds are classified in terms of how the interest is paid specifically from a part of corporate finance aspect. So the most important, the first is this decides the pecking order. So first is the senior secured bonds. These are the bonds which have legal claim on the property of the issuer in case of default. It could be mortgage bonds backed by real estate assets. So these are the others are unsecured bonds or debentures, which I talked about. So this is second in lien. So this is the most, so in terms of liquidation or whenever you have to pay the interest rate, these are the bonds which will get the first lien of assets or interest rates. Then it comes to unsecured bonds or debentures. And in that you have more, which is senior unsecured and then senior subordinate. And the last is subordinated debentures. So when we look at the peaking order, that's why I've put this arrow, is that it trickles down, which is called the concept of trickling down. The first would go to senior bonds, then unsecured debentures, then in that senior unsecured seniors. So this is various ways you could classify so bonds. Just very good idea as a thumb rule to understand. So let's start with the first, with a bit of a history of the bond. The first bond was, as we know from recorded history, which what I've got is at 2400 BC, which is present day Iraq. So in that time, the guaranteed payment was grain and corn. So in the olden times, it's very interesting. If you go back to history also of the Roman Empire, you will see the first forward was created in a way by a very famous philosopher, in which there was a agreement amount of, if I remember correctly, of gains of a crop being exchanged. So if you go back in time, so you'll know how people had their own terms of coupons or how the derivative structures were made. So it's very interesting if you go back to history and see how people in the olden days also did something very similar to what we're doing out here. The only thing is we have got more standardization now. So if you look at the first ever government bond, it was issued by Bank of England in 1693. It was used to raise to fund wars against France. So that's the first time was recorded history. And the first US bond offered was during the Revolutionary War. So we have a very interesting concept of coupons. So why we say coupons is the bearer bonds, wherein coupons were needed. So in olden times, in bearer bonds, although there was not directly any name attached, there was a registry done, and where the bonds were recorded in your name, and you had to give these coupons in order to get the interest rates or the principal back. So it's a very interesting how the coupons have evolved, how the name, the coupon, when we say the coupon rate, how it has evolved over a period of time, how it's come in. So let's look at actors in the global bond market. Now, this is a very important classification, although this is the classification which I've got for ICMA. There are various different types of classification. However, since I got this data, I've used this classification. So when we talk about global bonds and global equity markets, you will be very surprised. And a lot of people in India, maybe the equity market is bigger than the bond market. However, globally, if you see, the bond market is much bigger than the equity market. As a matter of fact, this is the secondary market, and also show you the figure of listed securities, the global listed securities. And if you look at the 2019 numbers, now this is August 2020, but the equity is 2019 numbers. So by the year end, so you'll see that almost the bond market is twice the size of equity markets. The biggest player worldwide ever in the bond market is the sovereign. Whenever I'm talking sovereign, I'm talking about the government. It could be government of those respective countries. Whenever I'm talking about agencies, these are agencies related to the government, which are government-backed agencies or government-owned agencies, and we look at this also as we go forward. And whenever I'm talking about supranational, now supranational are big organizations like OECD or United Nations. It could also be multilateral banks, which are actually backed by 2, 3 central governments. They have a worldwide presence. So these are also an important segment right now, and I feel like this segment is actually the segment which is very much involved in development work. Because when you're talking about World Bank, you're talking about IFC, you're talking about European Investment Bank, then there are a lot of other banks which you will see, Asian Development Bank, so African Development Bank. So these are like very important players who are playing specifically role in sustainable development goals. That's one sector where the present government has done phenomenally well. I mean, in terms of, if you look at the sustainable sector in SGDs, then the Indian government has done a fantastic job in that particular segment. So when we look at the global market size in 2019, we are looking at about $30 trillion. So this 60.3 trillion dollars. So this is what is, I've got the data for listed securities, and this is the data given by the World Bank. And this is basically the exchange rates are used to, by data is just basically from the year end of values converted to US dollars, basically as we see it. So now when we look at it, why are we trying to understand bonds? Now, let's say you are a startup, you're an incubator, it's one of the most important sectors for raising funding. Debt funding is actually, like we have seen, it's become by far more. As an economy progresses, becomes more advanced, usually this is one of the prime developing modes to be used for funding of startups. However, I would also say that a lot of companies have their own ethics, and they also have their own idiosyncrasies, which would maybe differ the particular statement, because a lot of people still like banks. For example, Japan is such a highly advanced economy, but still it's got a huge exposure. The corporate bond market segment is not very big. That's because they have huge reliance on the relationship between basically the public and private sector. This is very important in a lot of countries, so that also you need to take into consideration. So now we look at another major source of capital raising for governments. Basically, you want to fund deficits, you want to do large infrastructure projects, specifically in the municipalities. When you're talking about the bond market, is by far the best way to raise funds. It also gives you a very good way to do capital preservation. When you're doing portfolio management, you're going to be not putting eggs in all the basket, right? So you're going to be picking up, even in the fixed income side, you'll put something in GSEC, you'll put something in high yield bonds, which I'll be going to be touching just the concept today, or you'll be doing corporate bonds. So it helps you to diversify depending on your risk profile. So it's very important to understand how bonds work. So when we are talking about bonds, this is just a very small I've touched upon is like it's very important to understand the primary and secondary market. The primary market is which are the creators of the security, the new issuance. Basically, there are underwriting groups which actually right now first buy, which basically the investment banks, which would buy those securities before they sell it to other bondholders. So basically, in the primary market, the two actors involved, basically the issuer and the bondholder, right? So that's the market. Then the market gets created wherein more bondholders come in. So securities are bought and sold between these bondholders and investors through an intermediary. So over the counter is still one of the biggest sectors, is by far the biggest sector in the bond market. And the second market also, you have exchanges where bonds trade. So as we go forward, so this is what I have sort of divided. We have taken as government as one of the actors, corporates and one, both domestic and foreign, and agencies, supranational, and municipalities. So a lot of times government could include also agencies. It depends on how you do the classification. I like this classification because I got a clear-cut data according to the classification, and so I made that as three principal actors. So when we talk about government sovereign bonds, these is the largest segment and by far the most important segment. You could look at, for examples, uses treasury bills, notes, and bonds. So usually the thumb rule, if you are very correct, when your notes are used for usually medium term bonds, usually less than 15 or 10 years are known as notes. So whenever you're looking at US 10 year, you'll say US 10-year note, and bonds are of the longer duration. However, you could use bonds for, like I've used it for simplification the way you want. So these are some of the plays. Now the in terms of pecking order, the number one is US in terms of government and sovereign bonds. Second is China. Third is Japan, and fourth is Euro. This is according to the data which I have. It might have changed, and we'll look at those figures, which is predominantly very recent data. So bonds, like I've already said, is basically ranges from short term, medium term, and long term. We discussed about that is in the previous presentation, in the previous slides. Now, one of the special class which have come is very important for everybody to know, is that this is something known as the inflation linked bonds. So it's very interesting to have like tips, because when you're looking at real and nominal return, your real return is only return which you get above the interest, above the inflation. So if your inflation is 3%, and if you're taking a bond which is giving a return of 5%, then you're actually making a return of 2%, which is known as the real return. However, let's say if the inflation is 5% and you are getting a return of 5%, so basically your real return is zero. So this is one of the ways to sort of get yourself insulated against inflation, is to have tips. So in America, they have these tips is widely used, so they keep you in touch with the inflation. So basically your real return could be zero, but your nominal return will be equal to the return of the inflation which is there in the markets. So now we come to, I hope I'm not very fast, right? I'm clear, and I'll be right?
No, that's very fine. Yeah.
So, sure. Okay. So now we come to a very important segment. This segment I feel is like the segment of the future. Although we look at sustainable bonds, although there's still like less than maybe $500 billion, but this is a segment which is going to play a huge role, specifically in sustainable development sector. Now, whenever we are talking about supranational bonds, we're talking about which are predominantly issued for development purposes and these are the organizations which are backed by two or more central banks. So I've not written OECD. OECD is also supranational, right? United Nations, they also come under the category of supranational. So good examples are World Bank, IMF, EIB. EIB is in terms also one of the largest banks in terms of one of the parameters I don't remember right now, but EIB is a huge multi-development bank. Then you have Asian Development Bank, African, Inter-American Development Bank. So they are very big presence in Latin America. So these are some of the examples. So whenever we are talking about agencies, some of the biggest agencies when you're talking about around the world is Fannie Mac and Freddie Mac. So these are actually government-backed enterprises, and they play a huge role, in terms of a mortgage-backed security, securitization, which also we'll touch a bit today. Or you could talk about federal owned agencies like Ginnie Mae in the US. So you also in India have a lot of government-backed NBFCs. You have a lot of other, like you have NABARD, which is so much doing work in rural development sector. So you have a lot of these agencies which coming SIDB. So just to give you a fair idea, but when we are talking about. So this is the top 4 issuers of SSA bonds globally. You have US, China, Japan, and EU. So this is the data as of August 2020, which I got from ICMA. So this gives you a fair idea, because it's, the data could, you have a lot of times picking up data and putting into classifying into what the bond size is. So I was able to get the data for the different in that particular segment. Now we come to Indian bond market. Although my data is from Jan 2019, I tried to really find the data from the present times. I did not get, but we could make a model to get a fair bit data what the size of the total bond market in India is. But it's roughly about $1.9 trillion as of Jan 2019. Now, if you look at the major plays, is basically the governments. So if you look at if the government and the agencies is about $1 trillion. It's almost 52% of the market if you look at it, if the whole size. Then you have corporate bond market. So this is looking at 0%. It's not zero, it's actually 0.3. And then you have the state and municipalities market, which is about 19%. So one of the huge bond markets where a lot of reforms has already started, and I mean, a lot of things to be continued, would be in the corporate segment. So if we look at the corporate segment, and we'll look at, actually we'll do a deep dive in one of the, it would be the corporate segment in India. It's still held by, the primary market, 90% of the issuance, 98% of the issuance which I've seen, it still goes through a private placement route. This is the RBI data as of 2018, if I'm not wrong. And so it's very interesting as we go forward, we look at this particular segment, because this is very important. As the country goes up, the corporate bond market has to become much more vibrant. So when we talked about treasury bills, so when you look at this particular slide, you will see that you have government bill, and then you have government bonds. So the government bill, when I'm talking about, it's basically less than a year or a year, 364 days. So the treasury bill or T bill is about 91, 182 day or 364 days, and they are injured. So they are also zero coupon bonds, which I was talking about. So basically, all these bills do not pay you directly a coupon, but they are actually issued at a discount to the face value. If there are as a face value of 1,000, let's say, it will be issued at a discount of 970 or for a year. So you could pretty much calculate, what would be the yield of the bond from those figures. So let's look at the municipal bonds segment. Now, the whole idea here is to look at how the global markets, who are the principal players, and just to have a very brief, understanding of what these bonds do. So whenever I'm talking about municipal bonds, this is a huge segment in the US. Like specifically when you're talking about the US, it's also coming. It's a huge segment around the world. Now, when you're talking about state and local governments and the authorities, this is how they would be, raise their money in the capital markets. They are, tax-backed debt. So you could have revenue bonds. These are basically hugely used to finance capital-intensive projects like building highways and bridges. So this is very important segment. It's being used by major countries around the world to fund huge infrastructure projects. So even if you look in India, both in the corporate bond market side, I mean, infrastructure is a major player when we are looking at the bond segment. They're also are used to basically do to actually enable a long-term deficit. So if you look at in the US itself, all these cities and all these municipalities, they have huge ways of going to the market and raising money. So I just remember because Chicago, was also coming out with a lot of bonds, so which you have seen now over period. So a lot of bonds could be tax exempt. So when we look at the corporate bonds, which we talked about. So whenever we're talking about corporate bonds, is predominantly also known as the credit sector. These are bonds issued by the corporations. Now, we have seen these could be like this could be a lot of innovation. There could be medium term. These are structured notes. So today we are not going to options, and we're not talking about, but structured notes could be sort of lot of tailor-made basically bonds which are designed, which could have a lot of these options which we are not going to discuss, but could have also callable and non-callable bond, and a lot of these other kinds of but we are today talking about only plain vanilla bonds, more of them. Now, when we are talking about these corporate bonds, this one of the most important classifications is investment grade and non-investment grade. The non-investment grade initially came out from, they were known as fallen angels. Very interesting book. So if you want to read a bit about it, you could know more about Michael Milken in the US, who actually created this market. Today, they're known as speculative grade, but now today they are high yield bonds or junk bonds. Bonds, like we have seen, they can be secured. They usually always have a collateral. If they don't have a collateral, we'll also see those debentures. They have something very interesting known as sinking fund provisions, a lot of these. Now, why I brought in is because we look at a policy which is, we have also used in India, sinking fund is like when you keep parking your capital so that companies, this is the provisions which could be built in by your bondholders so that you're able to meet the commitment at a later date. So this is also done by in India by state government, so that they have these specific funds where they keep in and deposit money or capital so that they could face uh, whenever they go for it funding, or whenever they need to give back the capital which they have raised, they can do. They'll be much better in a much better position because you are actually building up your capital over a period of time. So the other very interesting aspect difference is accrued interest rate. So I'll just talk a bit about here. Here the calendar year is 360 when I'm talking about. So when I'm talking about calendar year 360, the what I'm talking about is that whenever you have a bond, you have something which is the interest rate which is accrued over a period of time. For example, let's say interest is coming out next Thursday, next Friday, and I want to sell the bond. So the price of the bond is divided into two. One is a clean price. Clean price is basically which does not include the interest, accrued interest paid over a period of time. So that accrued interest is for a corporate bond calculated over 360 days. For a government bond is different. It's I think about 365 days. So that becomes the difference. So whenever you're looking at the dirty bond, includes the clean price of the bond, and the dirty price would be the clean price plus the accrued interest which is pending for that particular bond whenever you're buying and selling. So the bond would ultimately have the intrinsic value would also include the accrued interest which the bondholder is expected to be paid. So now here this is a very good matrix when you're looking at the credit, when you're looking at the credit rating. So whenever I talked about investment grade is basically this particular part till triple B. So the highest quality is triple A. Any bond which is less than triple B is a below investment grade. So this gives you, so this is very interesting is that when you go into the market, now India corporate bond market is predominantly of investment grade. So if as the risk, if you look at they have very strong balance sheet. These are big time companies, large companies. It's also observed in India that the coupon rate would be different between public and private listed companies. So actually, I wanted to ask a question. Why do you think? So there was an analysis done by, and there's an RBI paper where there's a difference of when you're looking at multi-regression analysis. So you see a difference of 0.5. Now we'll not go into that, but what I'm trying to say is that which segment would you, you could answer this question so that I make it more animated. Which one you think would be giving a higher coupon? A private or a public player or a company, keeping other factors constant. Let's say they're all pretty good. They're pretty similar in size. Which one will give you? You could answer this question in the you have this particular chat. Would somebody like to answer that? Hello.
So we are waiting
Hello?
for the
Is somebody there?
responses, but meanwhile we can just carry on. Yeah, I'm like there'll be responses coming in shortly.
Okay, so that's very interesting. So it will always be public. So private sector players would always be paying you higher coupon because the perceived risk is more. So that is actually the answer. So so take it as a thumb rule. The higher the risk, the higher the perceived risk. Let's use the right word to be perceived. A lot of times, a lot of companies are perceived as, internationally also you look, but they were not that strong in their balance sheets. So whatever the higher the risk perceived, the higher will be the compensation in terms of a return, and that return would be the coupon rate in terms of bonds when we are talking about. So this is how it basically rules as a thumb. The higher the risk, the more return is expected by the investors. So to give you a fair idea. So this gives you a good credit ratings understanding. So credit ratings are also of countries. So countries also have similar ratings as well as the corporate bonds, which we have talked about here. So when you're looking at the corporate bonds, so this is a very interesting slide which I recently got. Now, if you look at the GDP, the corporate bonds to the GDP ratio, the size of the corporate bonds, you see India, a lot of things could be worked out. So this is one part where we could look at in comparison with other countries, and there's a lot of scope in which we could come up in this particular sector. So this is now some of the primary bond issuance over a period of time. So I got this to get you a fair idea. So this amounts to about 50,000 crores. So this could sort of vary over a period of time. This is if you see how much was the issuance. So you have to understand another very interesting point. Whenever you're talking about issuance, this new issuance, but at the same time, a lot of debt is retired also. So when you're talking about issuance in India in corporate bond market size, predominantly ranges from about 2 to 3 years, or the 5 year is the sort of duration which we are looking at. So if you take 50,000 this crores and you sort of equate it over a period of time, you will see how much is this segment moving. You could have a fair idea, although this does not include the government. This is a very good analysis to look at. So when you're looking at HFCs, housing financial companies, FIs, financial institutions, NBFCs, so these are the sort of, and then you have corporates. So this gives you a fair idea. This will cover agencies. This will be under the category of agencies. So financial institutions, if they are into development sector, then they could also be under the supra national segment. So this is just a fairly idea. Now, so this is another very interesting part. So I got this. I wanted to just show how the corporate bond market is moving in India. So if you look at the AAA segment, is the number one segment in investment grade. So AAA goes to 72.51%, whereas the non-investment grade, which is below BBB, is 7.67. So this figures is till November 2019. So if you look at still the lot of in India, although there are a lot of positive policies coming in, so there are one or two very important, very critical and very good policies which are taken by the government to boost the corporate bond market side. However, I think this is also because predominantly maybe the culture where still people are not very risk inherent. For example, you take the retail side. In retail, by 2018 figures, only 3% of retail participation is there in the bond market side. So that shows is how much we have a pull up when you're looking at how much we can pretty much go up in that particular segment. So just to give you a fair figure, if you're looking at in India, the long-term infrastructure funding gap is about $4.7 trillion. Is one of the RBI's according to one of RBI's paper, and the cumulative infrastructure gap which we have per year is about $526 billion. This until 2040. So this is how much money we need to and we can tap the retail market. So how to tap the retail market is another thing, but the retail market segment in the bond market, if it comes up, is actually going to be one of the game changers. So let's look at some of the very positive policy interventions to boost the corporate bond market. So in 2000, this is one of the rules which came in, was in SEBI mandate was to companies which have borrowings above 142 million to or have a domestic rating of AA. Also, then it was also moved to A. There was certain also things done which were sorry, just a minute. So just to give you a fair idea, so this could bring in. Now RBI, another thing has done is relaxed norms from withdrawal from consolidated sinking fund, which is what I was talking about, to enable states to manage liquidity problems without any additional borrowing. So this is also was also very helpful during the time of the pandemic. So you can read a very important paper which is titled RBI's paper, which is like liquidity management in the time of COVID-19 and outcomes report. So just to give you a fair idea. Now, these are some of the tools recently which have come out to manage liquidity. One is targeted long-term repo operation. Now, the repo rate is about 4%. It's very short-term funding. But what the thing is, banks could borrow at repo rates for 1 to 3 years with collateral, and for specifically if they have invested in for a period of 3 years, they were supposed to invest in investment grade corporate bonds, commercial paper. There's about 270 unsecured papers. Is basically used commercial papers with CPs here used to fund working capital and non-convertible debentures. So non-convertible, a lot of debentures could have an equity kicker, which is like you could convert into equity at particular predetermined price, or there are a lot of ways you could do that. So but these are just pure vanilla debentures. So this one particular was to raise about 1000 lakh crore. So this is 1 lakh crore, which is what they raised from the market, is about 13.6 billion dollars. So this was a targeted term. This is a very good operation to sort of drive in liquidity, specifically within the system during the time of the pandemic. Then there is Operation Twist. Now, Operation Twist is something which was done in America before. It was done in also 1961. This is one way of you actually do sale of short-term security, so you can long-term debt. You can also buy long-term or medium-term debt. So this is one good way where the RBI have used to bring down the yields of the 10-year bond. So if you see the 10-year bond yields, this is a very important tool. If you see in a way of whenever, let's say, you have the yields going up, specifically in sovereign bond markets, is not very good. So you need to use various tools to bring those yields down. This was also used by during the time of the credit crisis by the American by the Fed, and this I think brought down the yields to at that point of time historical lows. So one of the times which we are talking about, you could look at also the yields coming down in Indian bond market. So whenever I'm talking about OMOs, this is open market operations. This is used worldwide by central banks to drive liquidity. So to regulate liquidity, I must say. So how you do is like when you want to put in more liquidity into the banks, the central banks will come out with bonds. And when you want to drive liquidity, you'll start buying bonds. So when you want to put liquidity, you will be buying bonds, and when you want to suck liquidity, you will come out with issues so that you can suck out the extra liquidity from the bond market, from the system. So you need to move credit. The simple is like you put in more money in the balance sheets or give it to commercial banks, and they are going to be lending it further. So this is how you move the credit within an economy. So one we came in terms of amortization. So whenever you're looking at amortization, in this case, the principal is going to be repaid back over a period of time. When you take home loans, it's put down in terms of buckets over a period of time, small monthly wages. So this is a very good example of amortization. So just small concepts I come out in the presentation. So now we come out to another part, which is mortgage and asset-backed securitization. Now, this segment is not big in India, but I've read a bit that a lot of things are happening, at least in terms of infrastructure, where they're trying to securitize. We'll not go whether this is good or not, but this is one of the largest sector is the mortgage and asset-backed securities. So mortgages could be like residential or commercial, and when you're talking about asset-backed securities, it is car loans and credit cards. So loans. So this is very important. Is like resold and then sold to the investors. So when we talk about collateralized mortgage obligations, it includes structuring of cash flows into bonds of various risks. So basically concept of making tranches, which is what maybe you could look at in detail at different topic, and these different tranches are given different type of risk and different type of payments. So that is collateralized mortgage obligations. In this, the agencies are the major issuer. So we talked about earlier on the American housing agencies. So these are the ones who are some of the major players in this particular segment. So we come now to another classification. Now I'm not going to go into a very deep international bond market, but what we're going to be talking, whenever we're talking about external bond market, we'll go into something known as offshore bond market. Now this was also many times known as the Euro bond market, but Euro bond market has got very different connotations. So offshore bond market is a very loose term, but Euro bond market had certain certain connotations according to Fibonacci, as I have read that. And so the international bonds, they're basically issued in foreign currency. They have an international syndicate. No, usually it's issued across multiple countries, and it's written by a syndicate and not one country is under jurisdiction. But right now, in a lot of times you can have, which I'm going to be talking about, the masala bond. You have this companies going out to international markets, specifically one market, and raising cash. There are also bureau bonds, which I talked about initially, and they are basically listed. So actually, the first Eurobond came out in Europe. I mean, in the sense, because an Italian company raised funding in American dollars. So that's how the first time it came in. But it does not mean that the bond is usually listed in Europe. So I'll not now. There are certain things which I feel like there's a blur between the offshore and the euro bond markets. We'll not go into that. We'll quickly look at an offshore bond market. So one of the innovations which has happened in India, if you look at the World Bank, it released the first masala bond in 2014. The IFC, which is one of the divisions of World Bank, which is predominantly focusing on attracting capital in the private sector, is launched the first green bond in 2015. And so these are some of the, National Highways Authority of India raised about 467 million on London Stock Exchange. Kerala is was the first, government in India to go through route. So if you read one of my podcasts with Shilpa Popule, so there's this company in India which went through the masala bond route and raised capital. So a lot of companies which are of course in the matured stage, they've also got funded for sustainability. They big impact investors, as I say, came and invested into their firm. So this is one part which a lot of companies which are in the mature sector, maybe which are not listed in India, also could go through route. So this is a very interesting route. So the interesting part of offshore bond market is like you can go. So they went to National Highways Authority of India, for example, went to London Stock Exchange. I've not written what is the exchange rate at this point of time. So 367 million, let's say as a loose figure at that particular time, I need to mention what was the exchange rate at that point of time. Raised money from London Stock Exchange. So this money was actually raised in INR. So you've gone to you've gone to England, you've raised money in INR, which is Indian rupee. So what you're doing, you're actually putting the exchange risk, which is the currency exchange risk, to the third party, to the investor. So here, whenever I'm taking, let's say I'm going and issuing the rupee denominated bond, if in the masala, what happens is like the hedging risk or whatever the currency risk is with the investor, not with because if I had raised the money in pound, or let's say if I had gone to US and raised it in dollar or euro, whichever currency you're raising, you'll always have an exchange risk, and that's exchanges with the issuer. In this case, the exchange rate is given with the bondholder or the investor. So this is a very interesting, I would say, aspect of this particular bonds. So you want to manage the currency, there are a lot of hedging tools which you can do that. So nowadays companies are so sophisticated that they take all these measures in terms of taking those risks. So when you come to sustainable bonds, so this is one of the most interesting parts, which is of the late, which has come out in the last decade or so and has gone into prominence, I think, in the last few years. This is going to play a huge role in driving the sustainable bond market segment. Now, raise capital and deploy the capital in the development sector. So you have basically different types of bonds. I've written as social impact bond. I recently took out a module on impact bonds, which is very, very comprehensive. So impact bonds are two kinds: social impact bonds and derivative impact development impact bonds. And these are more like derivative structures. So this is an exotic called European structure. Now again, we'll not discuss that, just to sort of give you a purview. So bonds here is actually known as also pay for success. is basically a misnomer. So green bonds predominantly are in related to climate change action. They're different. They target more on they target actually the climate part of aspect. They also target oceans. So but blue bonds are very specifically covered for oceans. Then social bonds predominantly have related with the social aspect as well as the climate aspect, with the prominence given to social aspect a lot. Then you have sustainability as SGD bonds. So these are like typical bonds, but they are backed by green, social, or sustainable bond principles. They're very important principles, so they have to adhere to these principles. They focus on environmental, social, and both themes. So whenever talking about green bonds, is basically environment, and of course blue bonds is very focused towards the ocean sector. Now, blue bonds is also a theme covered by green bonds. So this is very interesting. This I think the first bond came out in Seychelles, Mauritius. So that's how the bonds were raised. So this is basically as a tool. It's still a very small tool, I would say, but it's a tool which is being used to cover up the United Nations has 17 sustainable development goals. Out of that, the 17th is public-private partnership. Now, these are the tools. If you want to achieve those goals, you have a dearth of about 2.5. It's close to figures could be 2.5 to $3 trillion per year. If you want to achieve those 17 agendas, it could go from no hunger to various issues, like it could be in renewable energy space, it is quality education, empowerment, women, inclusion. So these are the 17 goals. Now, if you want to achieve that by 2030, there's a huge segment. So there's a dearth of about $2-3 trillion per year. So how are you going to get that? So everything cannot be done by the public sector. That's where you have public-private partnerships, like you're driving in private capital. Now you're looking at, let's say, the international bond market, global bond market. It's about 1.2 more than $100 trillion. So even if you get 1% of attract per year, able to attract that, or you look at both the equity and debt markets, and if you are able to attract even 1% of that within the development sector year on year, if you increase it iteratively, then you have a huge amount of capital coming for development purpose. Now we will go to the sustainable issuance. So sustainable bonds as of issuance in 2019 was about 284 billion. So this is the issuance by countries which we have, and we have seen that the sustainability bonds are growing the fastest according to this particular sign. That's also one of the reasons, because the base was not very high. So this is very, very interesting aspect. So let me correct my statement here. When I've talked about sustainable bonds less than 500, I think it's very close to about $1 trillion. So I don't know exact figure, but I think the whole segment of sustainable bonds is dominated by green bonds, and I could give you the cumulative figure which you have raised till now, but it's certainly not more than $2 trillion. So I know I don't have the exact figure as of me with me right now. So let me correct something which I said. So if you look at the impact investment space, that's about $502 billion as of last year, according to GIN report. So, okay, so this is what we come to an end of the presentation. I could take in questions if you have any.
Surely, thank you, Nishant, thank you, and it was a really informational presentation, I would say. We have, I think, a couple of questions from the YouTube channel. I just want to bring in a couple of them. There is one regarding any example on the municipal bonds in India.
Okay, so you want an example of a municipal bond in India?
Yeah.
So municipal bonds could be bonds which are given by state, and I don't have, but these are bonds which are given by the state. So for example, I talked about the Kerala bond. So this could be a very good example of a municipal bond, if I'm not wrong. So state and municipalities, coming out. So Kerala was the first local government to go through route. So there is bonds coming out from these segments could be a part of it, but I could get back to you with a very specific example on municipal bonds. Very specific if you are looking at.
Surely. Yeah. Before I come to the next question from YouTube itself, I just want to relate the whole example of raising bonds and the current developments in sort of the startup ecosystem. Although it's plausible, right, for the startups to raise bonds or corporate bonds, okay, at the early stage and like that. But where is the threshold? Like, when should a startup, what is the stage where they achieve? As per you, like, what do you think about it? They should think about
Okay.
it. Besides going
Okay.
for actual VCs and bank loans, something like that.
Okay, so that's a very important question and it's a fantastic question. I really don't know at what is the gestation. See, what you have seen, if you're a very small side company, is very difficult in India. That's a clear cut fact. I would not know what the size is. So the recent report of RBI, which clearly states that predominantly all the bonds are in a AAA sector and listed. So if you are a company which is not even listed and your market size is maybe or your threshold size is even less than 100 billion, I think it's not that easy to go in. But nowadays you have venture debt which has come up for ventures, so you could look at that option. So nowadays, for example, also it's not a major tool being used around the world, but it's very popular in California for startups. Not very popular, I will say, but still it's you hear about venture debt coming in. So that is one route you could talk about. Now the other question is, like, if you're in the sustainable development sector. Now sustainable development sector, if you are there nowadays, people are giving you at a premium to come out with coming out with bonds. So one example I took about was Electronic Finance Limited, which I've talked for one of the companies. It's been there for a pretty long period of time, but that was not listed. The other you could look at is impact bonds. Now, impact bonds are a different kind of bonds, but if you're in the sustainable sector and you want to do, you raise money for a project, for example, now you have a lot of foundations who could come out with these pay for success structures. So this is technically not a predominantly bond. Of course, you are only paid unless you are able to achieve that intervention. So you had Educate Girls. You have one of the largest bonds now coming up, which is Quality Education in India, was $11 billion bond. Now, the way it is structured is multiple actors come in. So that is another wood, but I would not know at what stage could you really go to the market. In India, yeah, venture funding route, venture debt, which is what we talked about. Yes, that is something which corporates could look for. But I think at a debt at an early stage might not be also a good idea. But then it depends on how. Am I I've been able to clear on that?
Yeah, sure. Yeah. The follow-up thing, like, so there's a startup founder who has asked a question on the YouTube channel with us. He says, like, if we need to raise loans from ECBs, can we do it? If not, what are the options we have?
Okay, so external commercial borrowing is a fantastic route. So as a matter of fact, the recent report said that 13% of the funding, very specifically of the of the whole debt market funding was through the commercial borrowing route. So you could look at that. I really don't know the rules and regulations. I just took up. So commercial borrowing also works out in India because if you do look at the hedging and all the strategies, it still works out cheaper. And Indian government has taken certain, I think, rules and regulations where it's made a bit easier for you to go out and raise. Now, at what size do you do that? I really don't know. I mean, a lot of credit worthy of the organizations also, come up when you're going into this particular route. As I presume that you will be raising the funding through the Luxembourg or the London. Am I correct?
Sure. Yeah. Thank you very much. Yeah, I mean, like, this again, like, as I said before, like, this was really informational webinar for all of participants in the audience on YouTube channel as well. And we look forward to more insights from you. I would request all the participants to, if you have any specific questions, they can reach out to us, and we'll surely try to get connected with Nishant as well. Just before we
Thank you.
close,
Thanks for the invitation. I'm very glad I was able to, take some aspects of the things. I need to, maybe there are one or two corrections. I think I spoke about the sustainable bond market total. I think I need to get back also that figure, because what is the total bond market size? I need to also update you on that. That's another one.
Sure,
But I
sure.
sincerely really don't know how you raise money through the, I mean, how the nitty gritties are that you could check up. But external bond market, external borrowings is very popular. But from whatever I've heard, it's from AAA rated. So just to give you a fair idea, which I got from the foreign bond borrowings, which I seen is like about 14% of total debt. Of course, for a very startup, this will not be the best route to go in because in India still it's predominantly like we've shown, it's predominantly demand investment grade bonds, and abroad it's for example the which I was talking about example, which wherein an Indian company went out was certainly not listed. So we could look at ratings, but that's another segment you could go on. Electronica is the company which I was talking about, which has gone to external borrowing. It's like borrowed through the masala bond route from London. So that's one of them.
Thank you, Nishant. And I would actually request all the participants, if you have any other questions, further questions after absorbing all this, information and knowledge amongst you, please feel free to connect with us. And surely, Nishant, we're also looking forward to the next session, which we have next Thursday on the overview of emerging trends in sustainable finance. We look forward to that. Also, we really ask our audience if you have any particular questions around that topic of overview on emerging trends in sustainable finance. Please reach out to us, and we'll be happy to answer to you.
Yeah, sure. Okay, so we'll discuss on that. And also, I wanted to say that I'll make the deck of this whatever I presented today. So let me make a video deck of this, and I'll share the link so you can have this. It'll be a YouTube link, so you could look at it. So you could have the slides which keep on going through it. So I'll make a sort of a video deck of that.
Surely. Thank you very much, Nishant. Yeah. Thank you for giving us your time, and looking forward to the next week.
Sure. Thank you. Thanks a lot. Thank you. My pleasure. And I'm really thankful to Atal Innovation Mission and also the Niti Aayog for giving me this opportunity. This is the first time I've presented, and I'm deeply honored and privileged to be part of the work, the wonderful work which you are doing, specifically in innovation and entrepreneurship, to enable innovation and entrepreneurship within the Indian ecosystem, and not only within the Indian ecosystem, within the global ecosystem. Thank you.
Thank you.
Thank you.
Thank you, sir.